Hello everyone, this is Brian Resney, President of Resney Wealth Management. I hope you had a great holiday season. Of course, Christmas is officially over and the retail sales look like they're going to be pretty impressive from a lot of the early indications from some of the stores and some of the shippers like FedEx and UPS. You know, we're going to be ending obviously 2014 shortly. We're seeing improvement not only in the U.S. economy but also around the world. In fact, we're seeing more improvement in some of the emerging market economies. I firmly believe as we get into 2014, we're going to continue to see pickup in U.S. unemployment. We're going to see improvements not only in retail sales, but also auto sales and home sales. Now, don't expect super high prices in home sales like we saw, or prices in homes that we saw back in, let's say, 2005 and 2006. But I think you're going to see a very gradual increase in prices in homes. But I think overall building will pick up slightly. What you ultimately see is this. Rates are low if you look at historical perspectives. Rates are slowly on the rise up. People are looking to buy homes. People are saving more money. They're paying down consumer debt. And corporations are flush with cash. I wouldn't be shocked to see 2014 to be a pretty decent GDP or gross domestic product growth year for the U.S. and other countries around the world. This is going to bode well for asset categories that actually have upside potential. This is going to be a negative for bond investors in general. You know, we have literally received dozens of phone calls and emails just in the last week or so from non-clients, people listen to my TV and radio shows, who basically are ending 2013 on a very sour note. And we're seeing these people that continue to own the exact wrong asset category, which is overweighted bonds and often long-term and intermediate, along with a lot of closed-end mutual funds that have leverage that basically are paying high distribution rates. And again, a distribution rate isn't an actual yield, and as any investment goes, you need to look at total return, the income you receive and the gain or loss of the principal. Well, what's happened is this. We're seeing a lot of calls coming into our TV and radio show. People that were basically by their brokers were sold various closed-end mutual funds that deploy a lot of leverage and basically have a lot more risk as rates start to rise. This is an area that I feel in 2014 is also going to be worrisome, along with mortgage-backed REITs. This is another area that's highly leveraged and basically pays high distribution rates, but the total return for many of these investments, closed-end and these mortgage-backed security REITs, are often down 10 to 20% year-to-date. I think there's going to be a lot of investors who continue to own these thinking these are going to come back, only to be hurt more over the next 3 to 5 years as we see an improving economy. Again, folks, remember, improvement in the economy means tapering of QE, which of course Ben Bernanke stated last week they're going to start cutting back a little bit. This is a positive. We want growth in the U.S. economy. We want growth in the world. This bodes well for risk assets to actually go up in value. I hope you had yourself a great holiday season. Make sure you have yourself a safe and profitable week. If you're a client, of course, give us a call if you have a question. If you're not a client, call our office, make an appointment for the first of the year, start 2014 off in the right path and in the right way. Call us for a consultation. We'd love to sit down with you, talk about your portfolio, and get things turned around in a more positive manner. Have a great and profitable week.